Hi, my name is Christian Waldegrave and this is our conventional tanker market update for May 2013. Now, the start of 2013 has seen some pretty weak freight rates in the tanker market, particularly in the crude sectors, and particularly in the large crude sectors, so VLCC and Suezmax. And that's really to do with a couple of things at the start of this year. One is there's very strong growth in non-OPEC oil production, especially from the United States. So US shale oil production is growing, Canadian oil sands production is growing, and as a result, the United States is importing far less oil by sea than it has been in the past. In fact, US seaborne crude oil imports are running at about 5.2 million barrels a day this year, which is the lowest since 1991. So that's a negative for crude tankers, and it also means that OPEC is bringing down their production to try and support oil prices. So there's less oil has been coming out of the Middle East and West Africa. Because those OPEC barrels tend to be quite ton-mile intensive, it's been quite negative for the large crude tankers. And the second thing that's impacted on tanker demand in the early part of this year has been a very heavy refinery maintenance period. So the spring is always a period of refinery maintenance when refiners take their units and do some work on them between the peak winter and summer demand seasons. But this spring has been particularly heavy, so a lot of refineries have been offline, and that's impacted on crude tanker demand. The Aframax sector, which is less impacted by the long-haul OPEC movements, the rates in the Aframax has also been weak, but probably not as bad as in the large crude sectors. And we saw some spikiness in Aframax rates during March and April due to some seasonal factors. We had some late season ice in the Baltic Sea and some weather disruption in the US Gulf as well. So weak rates overall in the Aframax, but a little bit more volatility than in the large crude sectors. And on the product side, LR2 tanker rates, they started the year pretty well. There's been quite high levels of movements of naphtha from Europe into Asia. In fact, in the first part of this year, it's been running at about 1 million tons of naphtha per month going from the west to Asia, whereas usually it's about 500,000 tons per month. So that's given some support to LR2 rates through the early part of this year. Looking forward to the rest of this year, our outlook is that demand will improve through the second half of the year as the refineries come back and as the economy starts to improve as well. And also fleet growth will start to come off through the second half of the year as well as the order book rolls off. So supply and demand should become a bit more balanced as we go through the summer months and leading into the winter. However, we probably expect that freight rates overall will stay fairly weak for the remainder of 2013. For 2014, we see that the tanker fleet is probably going to only grow by between 2 and 3%, which would be the lowest level of fleet growth since 2002. When you combine that with a better demand outlook as the economy recovers, then we hope to see some better fleet utilization in 2014 and some better rates starting to emerge next year. So that's our outlook for the conventional tanker market, and we'll speak to you again next month.